to the sanctuary. I am Aura. In our last video, we briefly mentioned Warren Buffett's habit of hoarding cash, but because we were short on time, we didn't really dive into how that massive pile of money is actually working. So today, I want to dedicate this entire video to breaking down the logic behind their capital allocation. Once you understand how they are positioning their money, you can use this framework as a compass for your own financial decisions. You could say that Warren Buffett, along with his successor at Berkshire Hathaway, Greg Abel, is staging the largest and most decisive strategic escape in modern financial history. While retail investors are rushing in, Berkshire has quietly built a cash fortress approaching $400 billion. Do you know what a huge amount of money this is? That is more money than the entire annual economic output of countries like South Africa or Norway. Let's look at the data. And just a quick note, today I absolutely will not use those highbrow financial terms that give you a headache. I'm going to use the simplest, most human language possible. All right, now let's break down the macro drama playing out right before our eyes. To understand Berkshire's operations, we first have to figure out what that $400 billion actually looks like. That money currently makes up nearly 60% of their entire investable portfolio. The media often paints a picture of Buffett as a Scrooge, locking money in a vault and letting inflation eat it away, but that is a huge misunderstanding of how top-tier institutional capital works. That money is definitely not just sleeping. It's a high-efficiency, risk-free interest machine. Out of that giant pile of cash, only a small portion is just sitting in bank deposits. Over $339 billion has been precisely deployed into short-term U.S. Treasury bills. If you tried to stuff $400 billion under a mattress, do you know how big of a mattress you would need? The answer is that you would need a mattress the size of Texas just to hold it all. Or even larger than the entire United Kingdom, Germany, and Ireland combined. Let me think. Actually, between 2023 and 2026, short-term U.S. Treasury bills have been able to provide interest of 4 to 5%. Let's do the math. Even if Berkshire does absolutely nothing in the stock market, just by sitting on those interest payments, they can earn $15 to $20 billion a year without breaking a sweat. Buffett doesn't buy long-term government bonds because he knows that if interest rates change, those bonds can lose principal value. But short-term bills mature in a few months, so they earn high interest with almost zero risk. Since you can just lend money to the U.S. government and comfortably get a 5% return, who would be foolish enough to risk their life savings in a stock market with sky-high valuations just to chase a bit of extra profit? That is the logic of smart money, sitting there with a cup of coffee while collecting billions in interest. Following this patient waiting game, there has been a ruthless sell-off. Up to the first quarter of 2026, Berkshire had been a net seller in the stock market for 14 consecutive quarters. This means they have systematically drained over $172 billion out of the stock market. Let's take their two biggest stock positions as examples. Apple, which once accounted for half of their investment portfolio, was met with relentless selling. By early 2026, they had slashed their Apple position by over 75%. Bank of America met the same fate, also having its position cut by 75%. The reason is simple. These stocks are now too expensive, ridiculously expensive. Instead of betting on when artificial intelligence will actually start making real money, it is better to take those historic profits and lock them away. Of course, under Greg Abel's leadership, they aren't just sitting on their hands. They are just spending money where the math actually makes sense. Abel more than doubled their stake in Google's parent company, Alphabet, because compared to other tech stocks that have been hyped to the moon, Google's price-to-earnings ratio is actually down to earth. He also spent $8.5 billion in cash to buy a large home-building company. While the whole market is going crazy for microchips and software, Berkshire went out and bought a traditional physical business that builds houses. This is a very Buffett-style move. Speaking of which, I have to express my sincere appreciation for Greg Abel and the entire Berkshire team. When the entire Wall Street is popping champagne, being able to resist participating and spending several years with extreme discipline to complete this asset allocation, that takes an incredibly terrifying level of institutional discipline. The media might laugh at them for missing out on the tech bull market, but it is this steely discipline that distinguishes true wealth that transcends cycles from a lottery ticket that disappears overnight. Why are they being so extremely cautious? When we look at the true valuation of the macro market, it all makes perfect sense. The stock market right now is like a soap bubble that looks beautiful but is ready to pop at the slightest touch. The two indicators I am about to mention, I covered these in the last video, but I know not everyone has seen it. This time, I will explain them in a much simpler and more accessible way. The first is the indicator Warren Buffett himself once championed, the Buffett Indicator. It's an easy calculation even a schoolchild could do. Take the total value of all U.S. stocks and divide it by the U.S. Annual Economic Output, or GDP. It measures whether the virtual stock market has completely detached from the real economic base. By mid-2026, the total value of the U.S. stock market was about $70 trillion, while the total GDP was about $31.5 trillion. The Buffett Indicator smashed past 219% and later pushed toward 236%. To put this in perspective, in the year 2000, when the internet bubble was at its most frantic and people were losing their life savings, this indicator was only around 140%. Statistically speaking, exceeding 219% is an extreme valuation state that has never been seen before. The current size of the stock market is more than double the entire American economy. It's like a rubber band that has been pulled to a terrifying limit, ready to snap at any second. The second indicator is called the Shiller P ratio. It acts like a mirror that reveals the truth, filtering out short-term ups and downs so you can see how expensive the market really is. Recently, this Shiller P broke past 41. Since the Great Depression in 1929, there has only been one time in history where this indicator has broken 40, and that was at the absolute peak of the internet bubble in 1999. Simply put, when you buy a stock at such a high Shiller P ratio, it's like spending $100 to buy a lemonade stand that only earns $1 a year. The sky-high price you are paying has already prepaid for all the profits of the company for the next 20 or 30 years. This is exactly why Abel's team would rather hold on to cash. With zero margin of safety, buying in right now is like walking a tightrope over a cliff. Even scarier is that this cliff is packed with regular retail investors. The market is now an inverted pyramid, heavy at the top. The S&P 500 index is dominated by the top 10 companies, which account for 40% of the entire index's value. Just 7 tech giants account for tens of trillions of dollars in market cap. This creates a massive mechanical trap for everyday investors. Because index funds like the S&P 500 are market cap weighted, the bigger a company gets, the more the index is forced to buy. So, right now, the money from millions of ordinary people's retirement accounts and monthly automatic investments is being shoveled into these 7 tech giants at the absolute most expensive peak in their history. This has created an incredibly ironic picture. Wall Street venture capitalists and corporate insiders are dumping their shares to cash out at historical highs. Meanwhile, The buyers on the other side are regular people who think index fund investing is the safest path. Without even realizing it, retail investors have become the exit liquidity for these elites. Of course, understanding Berkshire's defensive strategy only gives us half the password. There's one absolute factor in this macro game that you cannot ignore: the Federal Reserve and its newly appointed chairman, Kevin Warsh. Every single one of their moves is the true puppet master deciding when this bubble pops and when the tide of capital turns. Because we are short on time today, in our next video, I will take you deep into the hidden logic of the Fed to see how the new chairman's policies will quietly affect your wallet. The world of capital can sometimes look like a massive, cold machine that makes you feel anxious and confused. But when you learn to turn off the noise and understand the real flow of money, you are no longer a player being butchered. You do not need to play a rigged game. All you need is patience and the courage to stand apart from the crowd. Thank you for your company tonight. Take a deep breath, let go of the fatigue of the day, and get a good night's sleep. We will see you next time.